Okay, and welcome back, students who are taking financial accounting. We're working on the Chapter 1 Business Accounting and U Theory videos, and we're up to the 11th video in the series. So let me just pick up where I left off from from video number 10. All right, this was what we left off with. Right? And so let me go to the next slide. All right, so now, as you can see, the difference in the slide, all right, um, shows that our stockholders' equity, what they've done is they've broken it down into common stock and retained earnings. And in the previous video, I had alluded to the fact that it all depends upon the kind of entity that the business is. Okay, if it's a sole proprietorship, that means the owner of the business, they control the business, and there is no stock involved. But that sole proprietorship, that owner can decide to incorporate the business, and therefore create shares of stock in the company. And that's, from a financial accounting perspective, that's how the information is taught. Okay. I don't know if that's the best thing in the world, but it's done because if I'm talking about, it's easy to backtrack and talk about sole proprietorships. But it's not as easy to go from a sole proprietorship to a corporation, because then, if I'm referencing everything as a sole proprietorship, there's no possibility for me to be able to deal with stocks, the issuance of stock, whereas stock is created because of a business becoming incorporated. So as we go along, I will be following along what's in the textbook, and I'll just constantly be sort of referencing what happens with a sole proprietorship, because the vast majority of businesses are, small businesses are sole proprietorships. So instead of having a stockholder's equity, which is used for incorporation, all it's going to be called is equity. And if we have equity in a sole proprietorship, we have what is called a capital account. All right, a capital account. And if you want to withdraw money from a capital account, there's an additional account called a drawing account. Okay, so that happens with a sole proprietorship. If you're incorporating, while you're creating common stock, right, being able to buy shares of stock in that business, and that's why it's called stockholders' equity. So common stock is created, but we also have an additional account that's created called retained earnings, which I alluded to in the previous video. Any profit or loss as far as as far as equity is concerned in a sole proprietorship goes directly into the capital account. Why? Because I'm the owner of the business. Any profit or loss that I have in the business comes to me. Okay. But when you're incorporated and you have stockholders' equity, well, the profit or loss and the profit or loss that you have in the business doesn't immediately go to the stockholders. Okay, so a separate account called retained earnings, and notice the terminology, earnings. What is profit or loss? That's your earnings. And the word retained means what you're keeping. Okay, and that retention occurs, goes forward from year to year to year, accounting period to accounting period to accounting period. Okay, so all of our profit or loss gets transferred into a retained earnings account. Now that retained earnings account, that money is used to run the business, to expand the business, grow, and if it's deemed, some of that money can be returned back to the common stock, or I should say to stockholders, because there's more than one type of stock. There's more than one there's more than just a common stock. There's also preferred stock, but that's for a later chapter in the book. So any of our profit or loss gets moved over to retained earnings, and along with the money that we receive for the common stock makes up our stockholders' equity. Okay. So we have the accounting equation, assets equals liabilities plus stockholders' equity, but the stockholders' equity is being broken down into common stock and retained earnings. Now we move down a little bit more, and what we see here is what makes up retained earnings. Well, I just had said that in that our profit or loss goes to our retained earnings, and we can take some of that retained earnings and pay, dividends, right? Return that to our common stock shareholders. So what we have here is, in the equity section, we're looking at our common stock, but we have plus revenues, less expenses, less dividends. And if you recall in the previous video, I had talked about the extended accounting equation being assets is equal to liabilities plus equity plus revenues less expenses, and I didn't add less dividends for the simple reason I didn't want to confuse issues at that point in time. But as you can see here, as we're extending this, we have, again, our profit or loss comes from our income statement. And what's on our income statement? On the income statement, we have revenues less expenses. That gives us a profit or loss. That gives us our profit or loss. Okay, and that profit or loss goes into the retained earnings account. So when we expand out our retained earnings account, well, we have to add in the revenues and then subtract out the expenses as part of our equity. And again, whatever is left over in that retained earnings, we use that to run the business, grow the business. And if there's enough in there, obviously we want to keep people investing in our business, so we have to reward, the shareholders, give them something back. So we take dividends out of the retained earnings and return that back to the stockholders. Because why? I mean, they're they're investing in the business with an expectation of a return on their investment, an ROI, right? They're not there to just give you their money and let you run the business and they don't get anything in return, all right? No, they want to see a return on investment, and that's why we pay dividends out of the retained earnings. So our extended accounting equation is assets equals liabilities plus equity plus revenue less expenses less dividends. Keep that in the back of your mind, okay? But really remember, you're talking about two different things here. You're talking about the accounting equation over here, which is on the balance sheet. And then over here you have the operation of the business, which is on the income statement. Keep that relationship in mind, okay? Build that as a framework on how to think about the flow of the information and where things go, okay? All right, let me look at the next slide here. All right, so now they're going to give you dollar examples, and since I'm at 10 minutes almost, I'm going to pause here, and then I'll pick up with the next slide, which starts to actually give dollar amounts to be able to record the business transactions. So I'll see you in the next video.